Hello, everybody. This is Stephen Gardner, best-selling author of Taming Wall Street. And today I'm very excited to speak with a longtime friend of mine, a colleague in the safe retirement planning space. And I'm excited to have Mr. Bill Grigorieff. He is the owner and founder of the Wealth Planning Group out of Bend, Oregon. And he has been involved in safe money planning for over 20 years. And today, he has given us some time to talk about the power of cash value life insurance. Bill, welcome to today's call.
Hi, Stephen. Hey, thanks a bunch. I really appreciate it.
Now, you got started, I believe, in California, and you've been doing this for over 20 years now. That's amazing.
It is, and who would have known? Got started in California, and yeah, I mean, it was really, it was a great thing to live through and work at some big financial firms, and watch the industry, in the 90s and in the 2000s, deal with crashes in the market, and really had opened up my eyes to how do I really grow money safely for folks, and how do I protect them? So,
yeah,
20 years in the safe money market.
Yeah, nobody wants to have that you've lost money or your account values have dropped conversation, and that's one of the things that we'll discuss on today's call. I really appreciate you taking time out of your day. So the topic today is the power of cash value life insurance, and those of you listening, is either a universal life, a whole life, or an index universal life, maybe variable universal life. Bill and I both stay away from that, but it's the ability to buy a life insurance plan in case something happens like premature death, but it's also a way to build a large pool of tax-free money in case you live. And so we build these for the living benefits. And so I want to talk about that. Now, Bill, I know you've been doing this for a long time. When you first got started, when this idea of being your own bank, or the infinite banking concept, or just using cash value life insurance to build wealth in a safe way, in a tax advantaged way, what was like maybe the first benefit that caught your attention?
Well, one of the first things, Stephen, was the power of the death benefit, what I'll call permission slip. You know, I didn't know this stuff. No one taught me this, but I figured out that the wealthy people, when they had a permanent plan, they actually gave themselves a permission slip to spend down other assets throughout retirement, knowing that when they did go, that they would replace all that they spent down and enjoyed through retirement with a tax-free death benefit. And I had never had anyone explain that to me, meaning this, that, you know, if you have a 401k or other assets and you get to retirement, most people thought that, with a death benefit that they had to die to benefit. And what it really did for me is it opened up my eyes is that you could actually plan on that death benefit coming in place when, you know, it was your time. But during that time, through retirement, it would give you the permission slip then to look at your 401ks, your IRAs, or other real estate or other just cash plans, and you could actually spend down and add to Social Security or pensions or whatever else those assets and plan them out for a 20, 30-year period. And the magic part was that you had a death benefit that would replace it all back to the beneficiaries or the family or a trust upon death of, you know, the usually the husband or spouse, depending how that was put together. And even through that, as you were growing through that, even if you spent down all your money, you still had the death benefit, plus you had the cash value in the policy should you need that for emergencies. And then if you had a terminal illness or something like that, you can really unlock the death benefit before you actually, you know, to help pay for that. So that was the first thing that just really was quite an eye-opener, and that as you were putting money into this, whether it was a whole life or a index universal life policy, that money wasn't at risk with market losses. It just kept growing and growing, whether you had dividends adding in or you had interest from different indexes crediting and making that money grow. That just was an eye-opener to me.
Yeah, no, I like that. I've thought of the way that you explain that, but I like the name you've given to it. This idea of giving yourself permission, and where I've seen this is really, I guess, in two ways. And I know you've run into this, but people finally get to those golden years, and then they're like terrified to spend their money. And what you're saying is, a lot of people maybe have courage or feel more comfortable knowing, hey, I am going to leave something behind to the remaining spouse. I am going to leave something behind to the children. But let's get real, more to the grandchildren, right? Because of this life insurance death benefit. But in the meantime, I give myself permission to live, maybe go live out your bucket list, to not be afraid of running out of money. Those are powerful concepts. And another area that I've seen this is, every now and then I'll have a wife say, I don't know if we should be putting money into this life insurance for my husband. We seem to have plenty of money right now. And I say, hey, listen, I can tell you love your husband, and you're most likely, statistically, going to outlive him. What happens when out of your love and your good, pure heart, you spend the majority of your money trying to keep him alive, and then he ultimately passes and you survive him, and now you're left with whatever's left over? Wouldn't it be nice to have a lump sum of tax-free money all of a sudden, bless your life? And that's when this light bulb goes on and they go, oh, okay. But yeah, it's this idea of giving yourself permission to use your other assets, especially taxable assets. Like, you might as well get through those and give your tax-free assets extra legroom, if you will, or growing time. So yeah, I really like that. With myself, when I was first introduced to this, oh gosh, over 12 years ago now, it was this idea of being your own bank, or this infinite banking idea. And we'll talk a little bit more about this later in the call, but just being able to create a pool of money towards retirement that I can access. And, I tell people all the time, when opportunity knocks, it's typically those with money that get to take advantage of the opportunity. And I had opportunities come up and emergencies come up when I had a 401k, and it was so painful to access that money. With this, it doesn't have that pain. So we can go a little bit deeper, but yeah, thank you for sharing about that, giving yourself permission, because what's the point of having this money if you don't use it,
Exactly.
Yeah. So, okay, now I want to fast forward. So you've been doing this a long time, just like me. Now that you've gone through a lot of real world experience, you've seen clients building up large pools of money, you've seen clients tap into that money. What's the favorite benefit of cash value insurance now that you've been in the thick of it for, many, many years?
Well, you're not going to believe this. I just got done with a client this morning. So just before the call, I actually have a client that we used a whole life policy, and there's reasons for whole life and there's reasons for index universal lives, which I tend to like the index universal lives a little bit more because of flexibility, but I'll talk about that. So my client this morning, literally, we just signed the document. They're borrowing $40,000 out of their policy. It's going to be EFT'd. It'll be in their account. It's the 20th, okay? It'll be in their account before Christmas. That's $40,000. They just want to have that buffer going through into the New Year's. They're expecting maybe a couple things may come up, and they may have some opportunities to buy a couple of real estate options. So they wanted to have that $40,000 just in case, and if not, they're going to put it back in the new year, after the New Year's, if they don't use it. But they know of something that's coming up, and so they said, can we get it by Christmas? I called the company, says, if we get the paperwork in today, they can have it EFT'd right into their account before Christmas. $40,000, okay, out of their policy, okay? Now, I have grown to really like, I mean, here's one of the things that people don't realize. You mentioned 401ks. So in a 401k, Stephen, you and I both know this. We've seen this. Most people don't realize that when you contribute to a 401k, and look, I'm all for people contributing up to the match, but everything else above that match really should go into a plan like an index universal, a whole life, infinite banking concept, whatever, should go into there, because you can put as much money into these plans as you want to. There's not a limit like there is in the 401ks or IRAs. But the real amazing thing is that, you know, you can take withdrawals out, which may or may not be taxable, but you can take loans out of your policy which aren't going to be taxable, and you can decide when, how to pay those back. So, for instance, the feature that I really love is that you can use the cash value that you build up in these policies, and you can use it to create other assets throughout your lifetime on the way to retirement, where in a 401k, you literally can't. I mean, you could take a loan out for $50,000 in a 401k, but it's got to be paid back in 5 years, sometimes with substantial interest, where, you know, hey, you can take a loan out of a life policy, and you don't necessarily have to pay it back, or if you are paying it back, you have the flexibility to say, you know, if you want to take a month or two off and not make any payments, you can do that because you control the terms. And people don't realize that. For instance, so a long time ago, I mean, I've been doing this for 20 years, I had a client that we got started at the beginning of my career, and in 2008, when the markets crashed, they had properties up in California, up at, I want to call it in the Sierras, up by Shaver Lake area. And they had these lots that were going for like $200,000, $300,000, $400,000. And no one wanted these lots anymore because the market had declined. But this client, you know, his money was in their life insurance policy because we had them funding that properly. So this client pulled out $50,000, picked up a lot for $50,000, waited about a year and a half, and sold it for $200,000. Made a huge profit, okay?
Yeah.
And during that time, that client really didn't make any payments on that loan because he controlled it. He just deferred the taxes, says, I'll make some money, I'll put it back in, and I will have made a chunk of money. And so he was able to use an asset that was a safe asset, but be able to pull that out and then control the terms. And, you know, I know you and I have talked about that, and I think you've probably done talks on how to, you know, use your insurance policy to buy a car and do it smarter than financing through a bank. And so there's a lot of reasons, but that flexibility is really great, you know, and it really works well on what I find the index universal life policies, where even while you're borrowing that money, you could be borrowing at a low rate, maybe 4%, maybe 5% on the high side, sometimes down to 3.5% or 3%. And you could be earning money, and if it's tracking different market indexes, you may earn 5% or 10% and have a pretty serious arbitrage that can help you, and you could use that money to help pay back those loans or not. So that's one of the other features that I really like, is that instead of locking yourself out of your money, out of your 401k till 59.5, where you can't put it in anything else other than the market, you can use these life policies to create wealth while you're growing, while you're going towards your retirement. But of course, you have to fund it. So you have to build up the value in the policies, and that's where you and I know, really work on advising clients how to, you know, fund these so that they have really good value going forward. I mean, yeah. You do the same thing, right?
Oh yeah, I love that story. Thank you for sharing. I had a client do something similar where they bought two rental properties, and they paid, excuse me, they took about $25,000, I want to say, out of their plan, and then got these two properties. And this was a couple years ago. Now the property values have gone up, but they got them, and then he realized he did not like being a landlord, and he took on a business partner. And the business partner didn't want any of the upside. They just wanted to be paid interest every single month. And he was like, okay, I'll take some of my money off of the table. He left about $5,000 of his own money in, and then took on this loan, and then they collected rent. And after 2 years, he decided, I don't want to be a landlord anymore. And they ended up selling him. Well, after he paid off the partner, he ended up making, on the $5,000 he had left out from his plan, he ended up making $69,000. So $64,000 in profit, and then returned his $5,000. And I mean, when he shared that with me, I was just blown away. I was like, oh my gosh, that's incredible. And he had to pay some tax on that, because he decided he didn't want to roll it, do a 1031 exchange and roll that forward. But he was okay with that. He just used some of those profits to pay the tax. But he made a huge rate of return on that. And again, it comes down to, he had the opportunity, he had the resources, and he took advantage of it. And so ended up being just an incredible opportunity for him. But yeah, thank you for sharing that story. I've shared this with you, but over the past few years, the majority of my clients have become business owners and doctors. Some of them are, work for hospitals or another doctor, but the majority of them own their own medical practice. And so as time has gone by, the thing that has really, I still love the be your own bank stuff and the infinite banking. I love all that. But for my wealthier clients, I started noticing this pattern where they didn't, I'll just say it and then I'll clarify. They didn't care what the rate of return was until they knew how they were going to be taxed. And then once they understood that, of course they cared, what the rate of return was. You would be a poor money manager if you didn't have some interest in that. But I just noticed the wealthier people are, the more concerned they are with, how is Uncle Sam going to take a bite out of my apple? And so they don't want to, give up more than they have to. There's nothing patriotic about overpaying on your taxes. And so they wanted to set themselves up for success. And as you know, inside the IRS tax code, any money that grows inside of a properly designed cash value plan grows tax deferred, and you can use those loans without tax. And then upon your death, that money gets rolled back to you with no tax. And so having this pool of money that functions kind of like a Roth IRA, but like you say, with no limitation on how much you can put in or how much you can earn. And if you die, a Roth IRA doesn't give you a leveraged lump sum of tax-free money. It's just whatever you've put in, where with the insurance, it's going to always pay you out significantly more than you put in, and it's going to be tax-free. And we have that blessing from the IRS, that permission from the IRS to grow tax-free. I'm sure you see people, once the light bulb goes on for them about, oh, wow, I can legally avoid taxes. That's a pretty cool program.
For sure. And that you're right. And having that leveraged, I mean, you hit it exactly in the head. I mean, you're buying the death benefit for pennies on the dollar. And you're right. I mean, a Roth, you only get what you put in. Here you get the cash value, and you're going to get the death benefit. And many times, that's a whole lot more. So you're going to get more than the cash value. You're going to get the death benefit tax free. Yeah.
No, it's incredible. I've used my own plan for paying for the birth of my third child. She was cesarean, cost significantly more than we expected. My wife and I have run 3 cars, multiple rental properties, and right now we're kind of sitting tight, just seeing what the stock market's going to do. But all along the way, we've been earning, and all along the way, any money that we have grown inside the plan is not subject to tax, so long as we stay within the IRS guidelines. And that's why I love being a money mentor with these programs. And I'm sure that you have had significant satisfaction in your career with helping people with these plans as well.
Oh yeah. I mean, you actually were talking about doctors, and I think one of the things that once a doctor realizes that they can fund these with some pretty substantial amounts of money, and then like I even have a car lot guy, and even doctors, sometimes when they need to finance or buy new medical equipment, the loan rate, if they want to buy those, buy that equipment, they can loan it through a policy, usually at a rate of 3 to 5% interest. They can expense that against the business. They can even pay themselves back more and pay it off, and have the flexibility that if they're having a rough month or two, or they're in a slow period, or they're taking a vacation, summer vacation, they can control those payments, where normally if you borrow that money from a bank, that bank wants that money, those payments, every month. So there is that flexibility for our, the wealthier clients. I had a car dealership guy, and he just looked at the numbers and said, "Man, I could fund that policy, and then start buying my car inventory using the cash value, and I could take loans, and at 4% loan, that was cheaper than the banks would let them loan money." So yes, very good.
Oh, that's amazing. Hey, this has been awesome. We need to do this again, but I do want to be respectful of your time. Those that are listening to this, this mastermind call today, we've had Bill Grigorieff, the founder of Wealth Planning Group in Oregon, on with us today. Bill, if someone wanted to find you online, how would they go about doing that?
They would go to wealthplanninggroup.info, all just one, spelled out, no spaces, just wealthplanninggroup.info, and they would get right to my site, and my phone numbers are on there, and contact information is there, and they can kind of read a little bit about what we do.
Oh, excellent. Thank you again so much for taking time out of your day. This is Stephen Gardner, best-selling author of Taming Wall Street. Taming Wall Street shows you how to build tax-free wealth that's guaranteed not to lose, and has a ton of tax advantages and the flexibility to use your own money, as Bill and I have discussed here today. It does talk about the power of using a properly designed dividend-paying whole life. It also talks about the index universal life. So that is available on Amazon. If you'd like to learn more about me, you can reach out to me through yourbridgeplan.com. But Bill, thank you again for being on today's call.
Yep, Stephen, thank you for calling me, and always a pleasure to talk with you, sir.
Thanks. Have a good rest of your day.
You too. Bye-bye.